okay, if I have these 20 employees, these 12, if they left tomorrow, I wouldn't be disappointed, right? These other 8 are the ones that I really rely on. Well, if you have the discipline to cycle out of those 12 and replace them and find more of the people that look like the 8s, your company is going to be much, much more successful.
Welcome to P&L, Priorities and Lifestyle, with your host, Rob Schultz. Rob is the founder and president of Schultz Wealth. All opinions expressed by Rob and his guests are solely their own opinions and do not reflect the opinion of Schultz Wealth Limited. This podcast is for informational purposes only and should not be relied upon for investment decisions. Please refer to our website for more information.
Welcome everybody to P&L, Priorities and Lifestyle. I am your host, Rob Schultz, and today I have Lily Tapia. Hey Lily, how are you doing?
Good morning, Rob. I'm doing great. How are you?
Very good. Thanks for coming on from the beautiful city of Miami.
It is nice. It's sprinkling a little bit today, but yes,
Okay.
It is a beautiful city indeed.
Well, very good, very good. Thanks for coming on the show today. This is a great show for founders, business owners who are trying to get to the next level, I think, and maybe need some help. Because Lily, you have a very cool business model where you come in and you help these founders and these owners get to that next level. So I'm really excited to have you and to talk about your model and kind of maybe some stories and some different ways that you can help folks. This is going to be a great show, and really glad to have you. So to start out, let's kind of talk about what you do with Exelvest. When you have maybe a client, a founder, or somebody that you're going to work with, tell us kind of how that relationship works.
Yeah, and it might be helpful for me to give you a little background
Sure.
that kind of led me to where I am today. So I have been working with founder-owned businesses and entrepreneurs for my whole career for 32, 33 years. I spent the majority, or 24 years, at Merrill Lynch and Bank of America Merrill Lynch doing corporate finance. Always focused on working with founder-owned businesses and helping founders think through their capital structure, both debt and equity, raising the capital they needed, helping them think through their growth strategy and then their exit strategy and how to optimize the value of their business along the way. So over those years, I got the benefit of learning from literally thousands of entrepreneurs that I worked with. And I learned as much from their successes as I did from their mistakes. And there are some common themes that I kind of saw in founder-owned businesses. Later, I went and worked in private equity, and then I started my own firm, Exelvest Partners. And what we do at Exelvest Partners is really 3 things. We help founder-owned businesses with their capital strategy, thinking through what the right capital structure is for them, debt and equity, how to source that capital. Sometimes we invest alongside those owners. So that's what we do on the capital side. The second thing we do, which is probably where we spend the most of our time, is we really become partners in the journey with the founders. We become partners on their team. We become partners in their success. And in that respect, we built a proprietary system that we call Frameworks. And Frameworks is basically a blueprint for businesses to think about how do you get from point A to point B quickly, how do you grow the value of your company, and how do you avoid the pitfalls that are very common in founder-owned businesses, and really businesses of all sizes, but in founder-owned businesses in particular. And it really revolves around the fact that it isn't necessarily the best business plan or the best product or service that wins. It's around discipline and framework to execute against a plan. So that's the second thing we do. And then the third thing we do, I call getting ready for prime time. So this is where we work with the founders to help them in a big transaction, whether they're looking to execute an exit strategy or an acquisition or a merger of some sort, and how do you put your best foot forward when you're getting ready to do a transaction like that. And there's a lot of science and art to getting ready for prime time.
Oh yeah.
So those are the 3 things we do: the capital, frameworks to help you execute, and then getting ready for prime time.
Awesome. So let's talk about the capital piece, because I know that a lot of times you'll take like maybe a minority interest along with, trying to help them find their stack and that sort of thing. So it seems to me, and correct me if I'm wrong, that a lot of the time, or at least the experience I have with who you've worked with, you're letting the founder owner maintain control of their business. Is that correct?
Yes, yes.
Okay.
So I partner with founders to help them really exceed their wildest dreams. That is
Okay.
my goal, to help the founder exceed what they're trying to accomplish in their business by becoming a partner on the journey with them. And that sometimes involves us making an equity investment.
Mm-hmm.
But the biggest investment we really make is of our time and energy and resources outside of capital, because yes, sometimes the cash is really pivotal for a business, but usually it's the other things we bring to the table are even more valuable than the cash.
Yeah.
So on the capital side, though, what I'll tell you is that we kind of take the big picture look first, and to determine what is the right capital structure for a company based on where it is in its life cycle, the consistency of its cash flow, the nature of its business, the history of the company, the ownership of the company. And the capital landscape has gotten ambiguous and complex.
Mm-hmm.
So you have venture capital, you have private equity, you have friends and family, you have high net worth individuals. So you have institutional investors and non-institutional investors, and then you have the whole landscape of debt options. So there's a lot of alternatives, and especially for a founder-owned business that's relatively young, and the owners, well, one thing that's very common is that typically somebody who's starting a business is starting that business because they have some specific expertise in the product or service that is in that business, or they've built a better mousetrap. They have something unique that they've thought of, and they have the guts to actually pursue starting a business around it. But 90% of the time, that person does not have a background in finance or accounting. So it's
Right.
important to surround yourself with people who can complement your skill set, and also kind of instill that discipline and that knowledge and that structure to help you launch the business with the right capital structure. And understanding the risk return profile of different investors and investments is really important. And so we spend a lot of time thinking through the capital structure with the businesses we work with and helping them execute against that strategy.
So one of the things that comes up, at least when I'm talking to founder owners, is control. So I wanted to talk about that a little bit and see what your thoughts are on it. They'll say, well, I don't want to talk to these investment bankers about capital structure and all that, because I don't want to lose control over my business.
Yeah.
What do you see with regard to that, and then what kind of insights do you maybe have?
That's a great question. And so when you look at the different options for investors, they come in every single flavor, not just categorically, because one might be venture capital, one might be private equity, and different categories, but also culturally. And one of the things I think about a lot, whether it's debt or equity capital that you're looking at, is trying to find partners who you fit the middle of their strike zone, the middle of their bullseye. Sometimes funds or investors, and sometimes businesses, enter into a relationship that isn't a great fit, either because the risk profile is not the right fit, or culturally it's not a right fit. And those relationships don't tend to go very well,
Sure.
whether it's a control or non-control investment. They just don't go well. Whereas if you have the discipline of really trying to find the right match, or matches, plural, where your company or your fund is really fits the bullseye, or very close to one standard deviation away from the center anyway,
Right.
close to the middle of the bullseye, then you're going to have a better go at it, whether it's a control or non-control investment. And having really clear expectations and articulating them clearly documenting them both ways, I think is also really important. So I think sometimes there are non-control investments where on paper you're not giving up control of the company, but you certainly feel like you have because the partners, just the investors make you feel that way. On the other hand, you might have an investor that has a controlling interest in your company and you feel they're the best partner in the world. So sometimes that control thought is more form over substance, and you really have to get to the substance and understand what is this relationship really going to feel like, what's it going to act like. And then it also depends on what the founder is trying to accomplish. Are they looking to take some chips off the table and aggressively grow their company where somebody else is taking the risk and they de-risk and therefore they give up a majority interest in their company? Or is this still a younger company with a lot of upside potential and it's still very risky and the investor still wants to the founder still wants to capitalize on most of that growth and they want to remain in a majority position? The other thing I would say is that giving up majority interest in the company isn't necessarily the same thing as giving up control.
Sure.
Because in the operating agreement and the governance documents, you can structure things in a way to make sure that you still have the autonomy you want to have as a business owner and CEO founder. But again, I think it's the right cultural match is probably the most important thing, and really setting really clear expectations.
Yeah, no, I agree, and I appreciate you walking through that because there are a lot of instances, and I get the feeling that a lot of the people that you work with are really sticking around for what we call a second bite of the apple, and that sort of thing. You know, they're going to walk hand in hand with you, with other investors, and so forth for a while. They're not just selling this thing and punching out. So, you know, hitting that bullseye, making sure you have a good partner, making sure you have good structure and all that, and is really critical. I appreciate that.
Rob, another thought that occurs to me is doing this soul searching and being very clear for yourself on your own goals and objectives and those of the ownership group. So oftentimes a business is owned by more than one person, or
Right.
there's more than one founder, and they don't always necessarily have the same goals and ambitions and expectations for their business. So when you think about how do I exceed my wildest dreams as an owner, different people have different answers to that question. And I think sometimes people erroneously think that the answer is, oh, I want to make as much money as I can. That oftentimes is not the answer. Usually that's like third or fourth on the list of things that people are trying to
Right.
accomplish. So I'll give you a couple of stories of companies that I worked with. In one case, me and the partners, the investors who backed this gentleman on this company, we grew the company very aggressively. We made lots of acquisitions. We grew. And the founder wanted to continue to grow aggressively and grow the company for an additional 5 to 10 years. The investors were already ready to have a liquidity event. And what we did is we sold the company to private equity. The investors all got their money back. The founder of the business was able to roll over a piece of his ownership. He took some chips off the table. He rolled over some of his capital, and he remains the CEO of that company. And now he's backed by a big institutional private equity fund. And he's growing the company aggressively, continuing to do acquisitions. And so he was able to achieve his objectives. And the original investors who backed him during his early and high growth period were able to achieve very attractive returns on their investments as well. So that was a situation where everybody really understood what they were trying to accomplish, their goals and objectives. We had a lot of clarity around the expectations by all parties. We executed against the plan, and it went phenomenally well. And the company continues to do very well. In another example, I worked with a group of 5 owners. So this particular company was owned by 5 individuals. 2 of them wanted to sell, the other 3 did not. So what we did is we came in and we partnered with them. And we helped them develop a strategy, capital strategy, growth strategy, and exit strategy to accomplish exactly what they wanted to do. But we first needed to determine what the objective was of each of the five owners. We first needed to all have very clear objectives, and everybody had to do their soul searching. And I kind of walked them through this process of kind of as a facilitator of asking questions and drilling down and getting everybody to really crystallize and visualize where they wanted the company to be and where they wanted to be in 18 to 36 months. We developed a plan once we understood everybody's goals, what everybody's wildest dreams look like. Everybody's are different. So we crystallized that, then we developed a plan, and then we executed against that plan. And what we ended up doing was selling the majority of the company to a strategic buyer. And the three gentlemen who wanted to remain involved in the company and retain some ownership in the company were able to do that. And they're still at the company today. So, and the two who wanted to exit were able to exit. So it's not a one size fits all. It's definitely being thoughtful and diligent, and it really starts with clarity around what everybody hopes to accomplish and what everybody's expectations are.
No, that's excellent. Thank you for that. You're speaking my language right now. We have a term for kind of what you described that we coined. We call it enterprise values with an S, enterprise values, and we define it as where the values of the owner meets the value of the business.
That's excellent.
And it's all that. It's like trying to sit down and say, because usually they're like, okay, how are we going to make the most money here? And it's like, okay, well, back up. What is it that you really want to accomplish in your life, first? And what's the role of this business within your plan for your life? And you end up going in a completely different direction sometimes than where they thought originally. So I really appreciate you talking us through that. Now, I love your term. I love frameworks. That's a cool term. I don't hear that a lot. I really like it. Yeah, go ahead.
The tagline is for businesses that work. So it's frameworks for businesses that work.
I love that.
And frameworks really has four elements to it.
Okay.
And nothing in frameworks in and of itself is earth-shattering or incredibly innovative. It's just pulling things together and creating discipline around business planning, execution, and holding people accountable to achieve their portion of what they have to do. So the four elements are vision, momentum, people, and visibility. So vision, it starts off with what I talk about all the time, and I've already mentioned it several times today. It's about having clear expectations. And when you're talking about the vision of the company at large, is making sure that the founders, the owners, can articulate very clearly what their vision for the company is. It's beginning with the end in mind. Mm-hmm. So vision, and then I say you have a mission and you have a vision. Mission is kind of your nearsighted, what you do every single day when you show up to work. This is why we exist. This is our mission. Vision is where you hope that the company will go, but hope is not a strategy. So we're going to build a strategy to actually achieve that vision. So it's mission and vision. And then in this section of frameworks, we work on your branding, your brand guidelines, your values, and making sure that your company is in alignment with your vision and your mission and your values, and you have consistency around your branding and the way you present the company to people. It's about alignment. And one of the reasons why this exercise is really important is because a common theme that you see with entrepreneurs, by virtue of the fact that they're entrepreneurs, is that they get excited about innovation, and I call it the Finding Nemo syndrome, because Dory in Finding Nemo chased every shiny thing. Mm-hmm. And you see this a lot in entrepreneurial companies where the founders, the entrepreneur, the visionary, gets excited about innovation and about different possibilities. And sometimes that excitement causes them to create some whiplash in the company because they kind of move from thing to thing without a lot of discipline around staying focused. And so in frameworks, we have a tool that we use. So once you've very clearly articulated your mission and your vision and your values and your brand standards, then every opportunity that comes along, you kind of push through this tool to see if it's in alignment with the things you've set out to accomplish in your business. And if it's in alignment, fantastic, let's pursue it. If it's not in alignment, then let's say no and move on. So
Nice.
it provides some discipline. And then the second thing is momentum. And momentum is about how do you execute against a strategy and how do you get things done quickly and efficiently and effectively. And it really requires every single person in the organization understanding what their role is and how they have to execute, how they fit into the company's objectives, and how they have to execute. So if you think of a pie chart, a circle with a pie chart, and every division in the company is a slice of that pie, and every individual in the company is a sliver within a slice. That pie has to be growing at the same pace. And one of the other pitfalls that I've seen a lot in businesses is that you'll have companies where one area of the company is executing exceptionally well, or certain people in the company execute exceptionally well, and others fall behind. And a company cannot get momentum and achieve value creation if you have that. And I'll give you an example. I worked with a company that was doing fantastic in sales and marketing and growing their brand and getting a lot of orders and just a high growth. But they had a big quality control issue. So in their manufacturing process. So they were getting a lot of returns. So what happens? This company is growing top line, but then the returns and the breakdown in their manufacturing and quality control issues prevented them from being successful. So you have to have execution across the company. So that pie chart has to be growing in lockstep. And that's momentum. And we have a mechanism and tools within frameworks to make sure that everybody within the company is being held accountable to achieving their milestones. And there's tremendous visibility and accountability. And people kind of self-select out if they're not interested in being in that kind of environment. And the interesting thing is that what you find is that really high performance people love that kind of environment.
Oh, yeah.
Because there is nothing more offensive to a high performance person than to be working with people who don't carry their weight. And who cause them to not be able to achieve the level of success they would otherwise be able to achieve.
I love that. So the momentum piece, I had a whole bunch of just visions going through my head while you were talking through that. Certainly vision is something that we hear a lot and we talk a lot about, and it's very important. But this momentum piece, I love for a couple of reasons. First of all, when you're talking about your pie chart and how all of them have to grow at the same time. Well, when I think about momentum, momentum is, an object that is in motion remains in motion, right? And if pieces of that pie chart grow higher than the others, and if you think of like a wheel, then you've got these pieces that outgrow it, and the wheel can't roll anymore,
Doesn't roll very well.
Doesn't roll very well. The other thing, just kind of from an investment standpoint, just to geek out for a second, there's definitely a lot of data, because that's what I do, I invest for a living, is that stocks, which are companies. I mean, a stock is a company just like, our clients' companies. And a stock, definitely, there's momentum that occurs with individual stocks. A stock that is moving up will continue to move up. A stock that's moving down will continue to move down. That's momentum. And there's something called momentum investing, where you try to find those stocks that are moving up and you grab onto them. And you don't let go of them until they start to slow down. This momentum deal is really cool. You can feel it in your own business, right? I mean, you can feel when you have momentum and when you don't.
You have that mojo.
Yeah, and man, you're trying to push that wheel and trying to get it going. You don't have momentum yet, and you're pushing hard and hard and hard, and then that wheel starts turning, and it becomes a lot easier, doesn't it?
So in momentum, we have three components of it. One is the map, which is where you're mapping out how do you get the company from that tiny little pie chart that you are today to the vision, and mapping that out, and then creating milestones for the company. And then that map and that milestone gets divided up by division and by individual. So every single person and every division within the company has their own respective map and milestones. So
Okay.
for the greater pie to achieve what we're trying to achieve, what does the sliver have to do? And what does the piece of the pie have to do? And so you're kind of doing things in lockstep. And then the third part of momentum is mattresses. And where this came from is that one time I was driving down I-95 down here in South Florida. Any of you who have been here know that that's a very busy expressway. And it was the middle of the day, and there was a bottleneck up in the road. And I assumed it was a car accident. Because it was the middle of the day, it wasn't rush hour. And as I edged up to the bottleneck, what I saw was that a mattress had fallen out of a truck, apparently, and was lying in the middle of the road. And everybody was just inching their way around the mattress. Right in front of me, a guy pulls over, gets out of his car, pulls the mattress out of the road, gets back in his car, and immediately everything starts flowing.
Yeah.
And so in a business, there are mattresses. There are mattresses in your business which are pain points that prevent you from flowing. It's those bottlenecks.
Yeah. Yeah.
And in frameworks, what we have is a discipline around every 60 days stopping and saying, are there any mattresses in the road? What are the recurring issues that we could either sweep under the rug and continue to battle with quarter after quarter after quarter, or let's get out of the car and get those mattresses out of the road.
Yeah, do the
let's
work.
do the
I
hard
love
work. Let's solve the situation so that the company can start to flow.
Yeah, and then you already kind of hinted towards the people piece. It sounds like this can flow pretty easily, to where you get a good vision and you stop chasing shiny things, all over the place, and you get some momentum because you're focused, and then you get some momentum, and then, you attract and retain people that like winning, and then I don't know what visibility is yet, so we'll have to get there.
Well, so let me talk about people.
Yeah.
In my experience, people is the hardest thing to get right.
Yeah.
And it's the most important thing in life, in business, in families, in relationships, and in every really aspect of life. People is the most important thing. And it's the hardest thing to get right. In fact, if you look historically and statistically, only about 50% of employees work out.
Yeah.
Over time. And only about 50% of relationships work out. That's why the divorce rate is about 50%.
Okay, so
and only 50% of relationships with vendors or customers really work out over time. But certainly that's true for employees. And if you're really good at hiring, maybe you get to a 60% success rate with people. But it's the hardest thing to get right. And so if you know that going in, how do you improve the probability of getting it right? Number one. And number two, what do you do? What discipline can you instill in your company to identify when you didn't get it right and move on quickly? And that's really, we focus on those two things. So the first thing around trying to make the right decision is, again, really about having very clear expectations. And I'd say that at least half of the time that an employee doesn't work out, it's the employer's fault and not the employee's fault. The employer lacks doesn't take the initiative or doesn't do a good job at letting the employee understand exactly where they fit into the company's plan, what their contribution are, the importance of their contribution, what their milestones are, how they fit into the greater picture. The employer, the founder, business owner, hasn't done a good job at articulating and clearly stating the company's mission, values, and vision. And so the employee is just kind of floundering and bouncing around and not really sure if they're doing a good job, not doing a good job, not sure what their prospects are for growth or how they fit into the long-term vision of the company and all those types of things. And then also on the employer side, giving really, really clear expectations about what success looks like in the role. What does success look like after your first 30 days here? What does it look like after 60 days? And because we use this momentum structure, there's a tremendous amount of visibility as to whether each employee, is achieving their milestones and actually doing what the company expects of them. So if you have the discipline as a business owner to be very thoughtful about what success looks like and what people need to, what each individual person needs to contribute and what their journey is alongside the company's journey. If you do a really good job at that, the probability of success goes up considerably. And you set those expectations up front and you let the employee know we have a high performance culture at this company. And we have a lot of discipline around high performance. So what ends up happening is people who don't want to be held accountable and who really are not high performance people opt out. You kind of learn that through the interviewing process. If you're very clear about the fact that you have high expectations and everybody on your team is high performance, and that's what you're building.
So the 50%, I was sitting there thinking about the 50%, and it sounds about right to me. So some other things that came to mind when you said that was, if in fact, 50, and if you're doing a really good job, maybe you retain 60. If that's the case, then you probably have to be pretty good at keeping your pipeline full as far as, potential new employees as well. And just realize that that's going to be a part of it. And then it sounds like to me that you can raise your percentage as far as who you retain by, being a very, very effective employer. But you're not going to raise it that much. But maybe what I hear you saying is that you're going to retain the right people, and the ones that aren't right for your company are going to almost self-select out.
Yes. Two things come to mind.
Yeah.
One is that some companies will retain 90% of the people they hire.
Okay.
Because they don't have the discipline to move on when they've made
so it's a bad thing,
hire, right?
It could be a bad thing.
It's a bad thing.
Yeah.
Yes, it could be a bad thing because they'll know, okay, if I have these 20 employees, these 12, if they left tomorrow, I wouldn't be disappointed.
Yeah.
Right? These other 8 are the ones that I really rely on. Well, if you have the discipline to cycle out of those 12 and replace them and find more of the people that look like the 8s, your company is going to be much more successful.
And I'm sure a lot of employers, probably you, and I know I've had this experience, and this is what made me realize that you have to be proactive from that standpoint is, when this has happened to me, like somebody quit, okay? And I was like, okay, and the first thing that goes through your head, right, I'm going to have to replace this person and all that. And then they walk out the door, and I've had it a couple of instances where they walked out the door, and there was just this huge wave of relief that went over my body. and I sit there and go, wow, why did I let it get to a point where I was inwardly happy when they left? That was not good management on my part, right?
It's an incredibly common thing, though.
Yeah.
It's incredibly common because it's time consuming, and it requires a lot of thought. So it's energy consuming and time consuming to have good people plans. And so what we do in frameworks through the discipline of having a map and milestones for everybody and accountability for everybody is that it serves as a perpetual performance management system. So you don't actually have to do annual reviews or anything like that, because every week and every month and every 60 days where we do our milestone reviews, you actually have tremendous visibility as to whether every single person in the company is achieving what they have to achieve for the company to achieve what it's trying to achieve, or if they're not. And it's a red, yellow, green system that we use. Okay. So literally all you got to do is look at somebody's momentum chart and you'll see, is this a keeper or not so much? Not only will you see it, but they'll see it, and everybody else in the company will see it. Because if you're on a team and the 3 of the people on your team have a whole lot of red on their paper, everybody there, including those people, know they don't really belong on that team. They're not accomplishing the things they need to accomplish.
Excellent. Very good. Okay, now let's get to the one that visibility. Tell me about visibility, because I don't understand that one yet.
Yeah. Okay, so I use a car metaphor for
Okay.
visibility. And there's a windshield, there's rear view, there's a back window, and there's side windows.
And there are blind spots
And
too.
and there are blind spots.
Okay.
Very good point. So most businesses, or I should say a lot of businesses, really only use their rear view back window, which is their accounting. So
Uh-huh.
they look at their financial statements. Usually they're looking at them well after the period end. So if it's a monthly financial statement, they're looking at it 45 days after the month end. If it's
Mm-hmm.
an annual financial statement, they're looking at it, 60 or 90 days after the year end. They're looking in their rear view mirror or in their back window at what the company did from a financial statement perspective historically, because financial statements are just a historical representation of what happened in a business, right?
Right.
So that's the backward looking. Forward looking, looking through your windshield, is having a really good dashboard and pipeline. So you see what's coming. What is coming your way? If you're an organization that is very sales driven, what does that sales funnel look like? What kind of activities coming in the front end? How is it? How are the conversions happening through the sales cycle? What is your lead time to manufacture your product? Or what's your inventory management? All of that kind of stuff. Forward looking dashboard. On your left-hand side, you have a window, and that to me is looking at what's happening in the industry. Many businesses, and certainly founder-owned businesses, tend to become very insular. You're very focused on what you're trying to accomplish. You're playing whack-a-mole every day, putting out fires, just managing whatever comes your way. And you don't pay a lot of attention sometimes to what's happening in the industry.
And does that mean
Or-
competition too? Is that kind of the same thing? What's your competition?
Absolutely.
Okay.
Competition exists, kind of traditional competition, non-traditional competition, disruptors, technology, AI, what's coming down, what is happening in and around your business that could impact you or that you could capitalize on, including what's driving value. So looking at any M&A activity that's happening in your industry, who's buying whom, who's investing in what, and what is driving the value, what are the value drivers, so that you can be thoughtful about that in your business. And then in your other window, it is being rigorous about your own analytics. And this is something that I see companies fail to do so often, which is, are you really paying attention to your trends and your margins and your inventory churn and your accounts receivable collection, and are you taking advantage of your supplier trade discounts and all of that type of thing. So being very rigorous about analyzing your business like an analyst would.
Okay.
Analyzing your business like a third party investor would.
So this isn't
So-
really, so when you're looking in the rear view mirror, you're looking at just your financial statements. You close the month, you're looking at your
We
your
hit our
cash flow.
revenue goal and our net income was
okay.
X.
And then you're talking about when you're looking at the right side, you're looking at your ratios, what your working capital is, what, all these different types of indicators. They're sometimes based on stuff that could be in the rear view mirror, but
Yes.
it's your current situation, and then you're also looking at how you can improve some of those numbers, right?
Yeah, and,
Okay.
and doing some trend analysis. I worked closely with a company once that financially, on their financial statements, were showing 80 million in EBITDA and weren't tremendously leveraged. I think they were leveraged about 2.5 times on that EBITDA, and they were growing. And on the financial statements, everything looked fantastic. You would look at this company and you say, this is great. And I was doing some M&A work for them, and I was sitting in some of their meetings, and they were talking about some cash flow issues. And I'm like, it doesn't make sense that this company is having cash flow issues. It just didn't register to me. There was something missing. And so I sat with the CFO and started asking him some questions and kind of encouraged him to do some analysis and look in certain areas. And what they found out is they had some serious cash flow issues because they had a revenue recognition problem, and then an accounts receivable collection problem.
Yeah,
So
there you
what
go.
their
Yeah.
financial statements, even though they had audited financial statements from a very quality firm, what they thought was their cash flow was not their cash flow. EBITDA is not cash flow.
Right. Yeah.
And adjusted EBITDA certainly is not cash flow. So being rigorous about the analytics in your business and the trends and the trend analysis.
Yeah.
Just because
Okay.
your numbers may look really good, but how are they trending? And then the last piece of the car metaphor and the 360-degree visibility is fuel, and that's cash flow.
Okay.
And again, you cannot lose focus on cash. EBITDA is not cash. It is not cash flow. It serves a very useful purpose when looking at businesses to understand their EBITDA and the trends in EBITDA, but it does not the same as cash. So having a 13-week cash forecast is something I also highly recommend in businesses. And what's interesting and ironic is that if you're ever in a turnaround situation with a business, the very first thing a turnaround specialist does when they come in is they generate a 13-week cash forecast. Why? They are laser focused on what cash is coming in, and there is not a penny that goes out the door that they don't scrutinize from an accounts payable and paying the trade. And so they instill that discipline in a turnaround situation because cash is really important. Well, I would argue that it's equally important in a growth situation. You need to have that same discipline and that same forward-looking visibility into your cash. EBITDA doesn't tell you that. Net income doesn't tell you that.
Well, yeah, because if you're in a growth mode, I mean, you need fuel.
You need fuel.
You don't
if
just
you're in a
need
growth
fuel.
Mode,
you don't just need fuel if you're just trying to get to the finish line. If you, like you said, if it's a workout deal, you need fuel to grow, and your fuel is cash. Could be other pieces, obviously, of a capital stack that we talked about before, but that cash, I mean, certainly has a role, no question. I like that.
And it also doesn't lie. So cash, so in accounting with GAAP and different things you could do in accounting, sometimes issues that are transpiring aren't completely evident when just looking at financial statements.
Sure.
In looking at cash flow, actual cash flow, you really have more visibility into what's going on in the business.
Very good. Man, I love all your structure. This is good stuff. This is the kind of stuff that that business owners can use, that they can continue to use, and you just kind of get back to the basics.
And like I said, it is. There isn't anything in and of itself that's revolutionary, but putting these building blocks together in a very disciplined framework that is easy to understand, it's very pragmatic. There's nothing. You don't need to have an MBA. This is basic logical stuff, but it's really about having discipline.
Well, very good. Well, this has been fantastic, and I love the structure that this podcast took, where we were able to go through your processes, also known as frameworks, and talk through some of that. Lily, tell us real quickly, so we can put it in the show notes, how can we get in contact with you? If somebody wants to talk to you about what you do or ask you questions and that sort of thing, how can somebody best contact you? Just tell us, what that is, and we'll put it in the show notes.
The best way to do it is by email.
Okay.
And reaching out, telling me a little bit about themselves, and then through email we could schedule a time to talk. So my email is Tapia, T as in Tom, APIA, at exelvest.com. EXELVEST.
Great. Okay. Well, I encourage everybody out there to reach out to Lily if you have any questions. This has been great. I really appreciate you being on the show, and look forward to seeing you next time you're up in the Metroplex. So
absolutely.
Thank you so much.
Thank you, Rob. It was nice chatting with you this morning.
Yeah, this was great. Thank you. For those of you who are watching, remember you can get this thing in your email, by just basically subscribing. And we'd love for you to subscribe. We try to put one of these out every other week. So click the button, subscribe, and promise we're going to have some more great guests coming up in the near future. I won't tell you who. You'll have to figure that out on your own. But subscribe and you'll get it dropped right in there. Everybody take care and have a great week.